Welcome back to Small Caps. My name's Kerry Stevenson, and I've asked Patrick Karim. He is the technical analyst and co-founder of NorthStarBadCharts.com. I love that, NorthStarBadCharts.com, because right now there's a lot of bad, there's a lot of good, but we've got to understand what's going on in the charts now. 3 months ago, Patrick and I had a really interesting conversation about what the charts were showing him. And funnily enough, when people tend to give up on things, it becomes really interesting. So, Patrick, first of all, welcome back to Small Caps. Good to see you. It's been 3 months since we had a chat.
Thanks, Kerry, for having me on. Yeah, man, time, it just flies by there. So, yeah, that's why I reached out. I said, there's a whole bunch of cool charts I want to show for your audience, and hopefully they see some value in it there.
Oh, I'm sure they will, because you and I spoke before, and you said, I've got some very cool charts about the housing market. Now, the housing market that you're looking at is Canadian, but basically it's the same, because down here in Australia, we're obsessed with property, obsessed. So are you saying that the charts are pretty much the same wherever you are, and the charts are showing you?
Yeah. I've looked at a whole bunch. So some of our members, I don't know if so bad charts, they're from UK, from Australia. So the Canadian house price index, the UK house price index, the American house price index, and even I think the Australian, I looked at it a little while back, they're pretty much the same. They go from bottom left to top right, with some periods where, like, let's say in the 80s, where they go sideways, and then after that, they go back up. So overall, over the years, it just looks fine, right? My house goes up, it goes sideways, sometimes a little dip, but overall they've been going up forever. But yeah, that tells you just a small part of the story, because when we dig and then you start measuring, yeah, house prices are going up, but are the wages going up? Are they following it? Am I losing purchasing power? And like, how are my house, how's a house priced in gold, right? Because gold, we know, tracks purchasing power. So if your house price is decreasing when it's measured in gold, that's actually that store of value that you think your house is providing you is not enough, because gold's showing you what it should protect you against. It should be rising even more, right? They're printing so much money, they're adding zeros to everything. So we got to use ratios to really discern what's happening in between these assets.
You said gold tracks purchasing power, but does it, given that Nixon took the US dollar off the gold standard back in 1971, is it even relevant to tracking purchasing power?
Yes, it tracks it. Like since 1971, since they unpegged it. And what's cool is because we have silver, we have oil, like any commodity, anything that's like real, they track purchasing power. And I did a chart even from 1914 with the oil price or silver price, and from the 1970s gold price. So purchasing power, the Fed, they actually have that data series since 1914. They tracked purchasing power, and it's pretty much reciprocal. It's an inverse image of the silver price since 1914. And people like, sometimes because people, they see the silver prices, the spikes in the 1980s, and they say, oh, well, silver's not, I lost my purchasing power, but silver's not at 50. But guys, it didn't stay that long at 50. But if you take the mean, like the long term for over 100 years, silver has been going from a quarter an ounce to $20, $30, $40, like the moving average. It's been protecting your purchasing power pretty accurately. And gold, I've done a whole bunch of gold charts. So you could also define purchasing power by taking the US dollar and adjusting it for inflation. And that also is the inverse image of the gold chart. It's the same chart, but flipped. So yeah, gold has been, it doesn't augment your wealth, it doesn't reduce your wealth, but over long periods of time, if you're able to zoom out a little bit and not look at the daily price action and start panicking because the US dollar is going up and then gold's going down, and say, or the inverse, over the long term, gold has definitely protected your purchasing power.
I want to talk about, I've got down here houses, inflation, gold. I actually also want to talk about the US dollar, because everybody's obsessed with the US dollar at the moment, saying the US dollar is going to be stronger for longer, and everything else is irrelevant. That's what, I'm hearing.
Well, yeah, the US dollar is the boogeyman. It's scaring everybody.
Yeah.
But gold will bottom 1 to 3 months before the US dollar tops. So I've looked at previous cycles, and every time the SPX breaks down, let's say, versus inflation, and then gold starts sniffing out that new secular cycle for commodities, for precious metals. Before that, there's an onset of a spike in DXY, just like we had, just like we're having today. And we'll see that as soon as gold bottoms, DXY is able to, like, it still has upwards momentum, so it's going to start topping a little bit. And after that, when really gold gets on the roll, then the DXY starts tumbling and it feeds. So as soon as the DXY starts tumbling, because the Fed's cutting the rates, and then less people want the US dollar, they decide to hold other currencies or giving like a better 10-year yield or overnight lending rate. They go to other currencies because the Fed's pivoting. Then that rocket fuels gold. So gold ahead of time prices in the monetary imbalances that the Fed or like the central banks are going to have to do to prop up nominally the markets. So I wouldn't be scared of the DXY. The DXY gold will tell us what's going to happen to DXY, or when gold decides to bottom and break out there, the DXY is going to, it's like a side story for me. But right now, yeah, it is wreaking havoc everywhere. So you have to let it burn out supernova style. And after that, you got to see that, Kerry, as fuel. So that's another way, guys. People are scared. Oh, gold, it's a dead asset. The higher the DXY is, the better it is for precious metals. Because if there's no DXY to unwind, there's no fuel for precious metals. That means the precious metals have already topped, right? That's what happened in 2013 or 14 when DXY was rock bottom. Well, where do you want it to go? So that's what was the top essentially for the precious metals. DXY reflated, it outperformed the euro and those other pairs. So I love a DXY that's through the roof, because every unit it goes up 110, 114, whatever it is, man, when it starts unwinding, that's just gonna rocket fuel anything that's inflation sensitive or that reflects purchasing power destruction.
Let's take it step by step, if you wouldn't mind. We mentioned housing just short a while ago. I know you've got a couple of charts on the Canadian housing, and you say the same works for others. So let's bring up the chart, if you like. In fact, I think you've got a comment about the very first house that you bought, which I think is really interesting, because the reason I think this one is interesting is because, as Patrick says there, he bought his first house at 25, you lucky fella. You can see it all there. He paid 125,000. Rates were 6.5%. Everyone today is like, oh, gosh. But you know what? I remember the days when they were 18%. Now, that house is now selling for 450. So what's that telling us, Patrick?
Well, look, I'm not like, I bought that house alone. I was making, I don't know, maybe close to 40,000 max back then. I put a 5% down payment. And I was able all to do that as a 25-year-old. I wasn't even in an apartment. I was able to put like that 5% on the side with like entry IT level job, like super IT entry level job. Now I'm just wondering, are there like the IT entry job? I've heard that it's not that much more. It's maybe 25% more than I was making, maybe 50% more they're making today. I'll be generous than when I was making back in the days. But look, now same rates, but the house price, the payments, they must be what, 4 times as much? So I have no idea how a 25-year-old. So for me, but I've seen people respond, but Patrick, now people, they buy it with their girlfriends and they do a whole bunch of stuff, but fine. But if I have to be 2 to buy the same thing, for me, that means you cut in half my purchasing power. That's what you did, right? If I have to sacrifice, or we have to be 2 to combine, then that's a 50% haircut on your purchasing power. And actually, maybe the next chart we're going to show after, when I show you the housing prices measuring gold, that's going to reflect that they've been destroying our purchasing power. And it's me and you now that we can't buy as much, It's like, it just, every single dollar we have. Yeah.
Patrick,
we just can't buy as much. That house, I sold it a while back, way before it was 450.
Shame. I always say to people, if you own property, keep it and then buy the next one. But that's hindsight. All right, let's go to the next chart, which is actually going to show us more in a more interesting way about the peaks and the troughs and the gold.
Yeah. Well, for so this is the house, the Canadian housing price, but measured in gold, guys. So I'll show you after that what it looks like when it's not measured in gold. You guys are going to go nuts. So here, actually, when I bought that house for 125,000, I actually bought at the peak of the housing bubble. So yes, guys, the housing bubble was actually in 2001 when you're measuring gold. That's when houses were their most expensive measuring gold. Gold was like 250. And so even if the house was 125K, it was worth a lot in purchasing power of that house, right? Because with a small income, I was able to buy a good piece of real estate. So that since then, they've been depreciating our money since the dot-com bubble, lowering rates, printing money, all that stuff has made that the houses in Canada actually bottomed in 2011, measured in gold. So gold in 2011 had priced in a lot of the purchasing power destruction. So now after that, real estate had a small move up, but right now it's back testing what I call a sleep mode line. So the next wave, and maybe this inflation, the next wave of rate cuts or the next wave of inflation we're going to get for the next 10 years is going to bring this down even more. So houses, when you adjust them for gold, which represents your purchasing power, they're going to be worth less and less. And I didn't even like discount more expensive heating bills, more expensive reparations, insurance, like that's another thing. Because back in 2001, the upkeep cost of that house I had was practically nothing, right? Electricity bills were probably half, a new roof, probably a quarter of the price that we have to pay today. So housing, guys, this is a big wake up call. Housing has not been protecting your purchasing value. Of course, you have to live somewhere. I'm not like somebody's first house, fine, you have to live somewhere. But if you had the choice, if the bank would have lent me a mortgage on gold, I would have made more money buying the same amount of gold than I would of buying that house at 125K. But that's another thing, right? No banks can lend me 125,000 to buy gold. They don't even consider it an asset, I think, like that you could.
It's interesting though, Patrick, because it is changing. Gold was seen as a tier 3 asset.
True.
And just recently they've made it a tier 1 asset. Now that to me says that people are starting to sit up and take notice. But I'm fascinated with this wages versus and the gold versus the housing. What's this telling us?
So, all right, fine. And I remember like before we start talking, okay, Patrick, but what about the wages? Did they go up, right? So I mentioned before that I don't think my wage, an entry IT job went up more than 50 or 60%. Even if it doubled, it wasn't enough. So here I have Canadian wages versus home price index. So as this goes down, that means the wages are underperforming housing. So housing prices are probably going up at this stage, but wages are not going up as high as the housing prices. Mm-hmm. So in 2000, in 2000, houses had peaked versus gold. And in 2000, wages have peaked versus houses. So that means your wages versus gold. So your purchasing power has lost on 2 layers of assets, have lost that purchasing power. So that's why you need to be 2 in a family, 3 in a family, keep your kids in there. You have to give the money to your kids for the down payment for the house. Like you have to go through your assets to try to spend some of your savings to try to offset that, what your wages cannot purchase. So that was pretty incredible. And now it broke down again back in 2020. So wages are getting demolished by housing prices, and housing prices are getting demolished by gold. So it's scary stuff.
People don't see that. People don't see that housing prices are being demolished by gold. Are you able to show us visually what you mean by that?
Yeah. So here, guys, this is just the Shiller, the US index price, right? So bottom left, 1988 all the way to today, housing prices up and up. This is 2006 peak before the 2008 crash. Then in 2008, yeah, you see they had issues. But the 2001, you see, it just kept going up and up and up. So that's what everybody sees. That's what a sales rep or somebody's gonna say, hey, buy a house. Look, it's going up here. Yeah, there was issues here, but we're never gonna get a mortgage back to all that toxic stuff doesn't exist anymore. But what it doesn't show you, or is not aware of, is that this is the Shiller index for house prices divided by gold. So measured for something real, right? Real money, something that reflects purchasing power. The house in the States peaked in 2001. And then they had a little go at it. Maybe 2005, they hanged in there. But after that, sayonara. It's like, oh, here I have a whole bunch of lines. So right here, it just broke down. So even if nominally they look great in 2006, they were already off, way off their highs in 2001. It was the whole thing was already unwinding when measuring gold. They weren't housing prices were not going up fast enough, as fast as the purchasing power destruction they were doing to save the US equities after 2001, lowering the rates, all that stuff, man. There's repercussions to that. And if you don't look at the correct metrics, if you don't measure stuff in gold, it's all an illusion, Carrie. People, they'll be bamboozled. Oh, my house is worth $1 million. I feel great. I bought it 500,000 2 years ago. I feel great. But what? It's like there is here this move up here in housing. They've been since 2020, they've been outpacing gold. Since when gold peaked pretty much in the mid 2020, there's been this rush up here in housing pricing versus gold. It's pretty much that housing pricing they did go up, but gold also has went down a lot since then. Since like 2000 went down to 1600.
Yeah.
And this tracks the US dollar. So if you look at that, I'm just going to hide this one here. Look at this. This orange line here is the US dollar. So the DXY is also representing this chart here. So the stronger the US dollar, the more essentially it's part of the purchasing power mechanics, right? Because it's inflation adjusted DXY is practically the inverse of gold. So if DXY is going up, that means your purchasing power to some extent is reflating, right? Because your US dollar is able to purchase you more, etc. So that chart's going a little bit up. So if you think the US dollar eventually will have an unwind like it did here in 2000.
Wow, that's a big unwind.
Yeah, that was a big unwind. And that's rocket fuel, like I said, for the precious metals, right? You want a crazy high DXY. I'll remove all my drawings. You want the DXY to unwind, because when DXY goes to the moon and people think it's going more to the moon, then that's when things reverse and it goes down. So there's a bunch of elements. We want to see gold going up. You want to see this line break here. So you want to see real estate break down once again versus gold. So keep an eye on that. There's still a few more like metrics to see to really confirm that gold is in the precious bulls era. We could cover some charts a little later, but when this breaks down, DXY is probably going to be topping like it did back here in 2000. The Schiller index broke down versus gold, and you'll see that once it peaked, the DXY was still able to, for a couple of months, many months, even go up a little higher, right? But then eventually it will break down. So
what do you think?
We gotta wait.
What do you think is going to be the catalyst for, I guess, the US dollar to weaken? Because to me, it seems like it's the only game in town at the moment, and everybody's flocking to USD right now.
A CPI, look, I'm looking for a CPI, a much lower CPI. I think that's game on. It's over for the US dollar if the CPI goes down. It's kind of contrary thinking, but I did a chart that gold bottoms when CPI breaks down. So every time the CPI has been going up and up and up, as soon as the CPI breaks down from rising uptrend, that was the bottom for gold. Because gold probably sniffs the next wave of inflation that's going to come after. So if there's going to be a next wave, gold's going to sniff it out, but it's not going to wait to price it in. While the markets say, oh, CPI inflation is going down, gold's okay, fine. I priced in that top in CPI before we got there. And now I'm going to start pricing in the next, I don't know what the psychology is. Maybe you could make an argument that if the CPI goes down, it gives more leeway to the Fed to start cutting. Oh, CPI is down. All good, guys. We could cut the rates again. But that monetary easing, gold sniffs that stuff out, man. There's a price. You got to pay the piper, and gold will reflect that destruction of purchasing power. So I think that I'm just waiting that, or at the same time, we'll probably get a high initial claim in the jobless initial claim. So that's another one where when initial claims right now, they're super low. As soon as that breaks to the upside, that matches with a CPI breakdown and matches with a 30-year divided by the 10-year. So the long-term prospects of inflation versus the short-term, they break to the upside. So people are going to start shifting their attention to longer-term inflation versus the shorter term.
Yep.
All that stuff, a few of those charts, when they mesh together, they're going to give a green light there for gold, precious metals to go upwards.
From a psychological point of view, how do the charts always kind of know what's going on versus humans that really don't know what's going on? Humans, we're kind of guessing right now, Patrick. I get it all the time from people saying they're confused. The market is volatile as all get up. You know, one day we're way up, one day, next day we're way down. People are excited and then they're depressed. What's going on?
Look, that's why you got to look at charts. You got to take a step back. All these guys, all these analysis guys, all these headline news, all that stuff, or whoever listens to those headline news, whoever buys based on the headline news, whoever doesn't buy or does the opposite, all these people, eventually they're going to put orders in the stock price and we're going to see it in the chart. So it's super easy. Like, I can't believe it's that easy. All I have to do is just observe the price action and I'll know as an aggregate, as I'll know the entire financial markets, what they think is fair value, or if there's a struggle in the basing pattern, I could identify that. And if there's a breakout, that means there's a change and the market's going to try to reprice something. And then I could write that repricing as defined by the breakout from a huge base to the new target where it's going to plateau eventually. And then I'll take my profits. Look, I put out this poll and I want to see people, what do you think is going to happen when the US, when they pivot the Fed? Melt up or panic selling? And I kind of knew the answer because I did the homework before, but 71% think there's going to be a melt up. They're so conditioned to think that the next pivot will be, oh, free liquidity, everything's going to go to the moon. But I had Kevin Wadsworth there, my partner at North Star Bad Charts. He did this chart and you'll be surprised that, look at that 2001 Fed pivot. Market just tumbled even more because there's reasons why they pivot. Like you could probably put a narrative that there's, because of SPX broke down versus PPI versus inflation. Now they're pivoting for the wrong reasons. They're pivoting because if they don't, something's going to implode. So they have to create more monetary imbalances. But SPX is rolling over because of inflation most of the time. Hits the margins, the price to earnings, everything like collapses, right? They have to raise prices. Nothing's good for SPX, for growth stocks when there's inflation. 2007.
So what you're saying is, watch, like a lot of people are saying, well, when the Fed pivots and those interest rates come off a little bit, it means we're off to the races again. And you're saying the charts tell us the exact opposite.
Yes.
What you're saying is the charts say when the Fed pivots, the market panics. Is that correct?
Yes. And that's why, guys, you need 100 years or 50 years of data because it depends when they pivot. So when they pivot, when the SPX has broken down versus PPI, the dynamics have changed. So now it's like the solution, because let's say you're underwater instead of being out of the air, now it's going to suffocate you. Because you see here there were pivots in the 80s, but because the SPX was above its 3-year moving average, coasting up, that was great. They were pivoting in a growth environment. No issues here. They were pivoting for the good reason, just creating more liquidity slowly but surely. There wasn't that much inflation. They were lowering the rates because inflation was probably coming down. That was fine. But look here in the 70s, when they start pivoting after the US equities were starting to get hit hard by inflation, man, no good. And those we all know in hindsight, all those were precious metals, gold, silver, all that stuff went ballistic, right? So this is like everybody's happy in the past couple of days or 3 days, and that's fine. And look, if ever the price goes back above my wake up lines and US equities go up, then I'll revise like the thesis. But right now, the weight of evidence shows that the US equities are I don't know how they get out of this. I think they just need time. Like they need 2, 3, 4 recessions of cleansing, and then they could probably climb their way back up like they did. But this is probably just the first leg. It's going to be like 2001. They're going to get up and then they'll get bamboozled. 60s and 70s did the same thing. They got demolished and then they got up. Nominally, they did a higher high, but after that, it just fell. So
well, it's almost, Patrick, it's almost like where we are right now, because we had a little bit of a sell-off in the markets, but the last couple of days, it seems like we're off to the races again. With the markets are up, gold's up. Everyone seems to be like, oh, everything's okay in the playpen, but perhaps not.
no, exactly. I zoomed in because there was somebody who said, hey, Patrick, it looks like 1962. But then I zoomed out. I did SPX divided by the producer price index. It was a beautiful rising trend line above a 7-year moving average, above the green Ichimoku cloud support. So this bounce here that was super healthy. It still had upwards momentum, but and here it did another bounce, but the momentum was slowing down. And as soon as it broke down that rising trend line and below the 7-year moving average and below the cloud, I'll zoom in here. Just keep this mental image of where it is right now. Look where we are today. Beautiful rising trend line, a bull cycle above the 7-year moving average, above a cloud, above, but now it broke down below these two very important trend lines, at what a longer term one and a short term one, below the 7-year moving average, below the cloud, below. It's like, and this is where it closed last month. And this is what the past 2-3 days have created this, the white candle going back up. But when you take a step back, this could just end up being a wick. It could be like here, you see, look here in the 70s, look, all hope. What kind of hope do you think happened in October 69? Crazy hope. Oh, everything's back on. We were up. That candle was up 4% for the month or 8% for the month. It's great. It's go 60s. I'm going to buy my IBM stocks. Well, rug pull, baby, because that inflation's coming and all that stuff, the easing, like you're just we're on the wrong side. If this was happening, Carrie, above, I'd say fine. We're like here, we're gonna bounce, you know. But right now we're below. So your bias has to be bearish right now. It has to, just because of the fact that you're below these important trend lines. I could show you 2000. Okay, here's a 2001, a beautiful, beautiful rising trend line above the 7-year moving average. And the 2000 top looks a lot like today. And look, below a top, below, and right now squeaking out of the cloud, below the rising trend line. It's like, it's this all over again. It's a rally here. I could have put in here a tighter, because the 2000 was so aggressive, Carrie, that it's like another rising trend line. It's like we're here somewhere again. It's like this rally here is going to get destroyed. Like right now, you cannot trust this rally right now. What's happening right now?
So don't trust.
Did I scare you? Sorry, guys.
Don't trust the rally. But Patrick, what would you do then in the like? You've got a lot of people that are listening. If you don't trust the rally, how do you protect your wealth and ultimately, even in these crazy times, how do you grow your wealth?
Well, right now, it's not going to be U.S. growth stocks until, I don't know, 8 years, 4 years, like down the road. Here, guys, this is how you know. So this is the gold. The black line is gold versus SPX. This is the final Rosetta Stone. This is the final key. When gold breaks out versus SPX, the capital flows have left U.S. growth stocks and they've entered precious metals. Hedge fund managers, whoever the powers that be, now the mathematics makes sense for them to start putting some horsepower in gold in those sectors. And you'll see here, I overlaid the silver chart, uranium, gold and silver miners, and these track the gold to SPX performance. So the more capital flows gold is able to steal from the SPX, it drives the silver metal, uranium metal, gold and silver miners, even the uranium miners, put all of them there. We're so close, Carrie. It's right here. It's like we're very, very close to breaking out like we did in 2002 or even the late 60s. And here's the momentum. We're rock bottom. We're not sky high. Here is where you sell when you're stretched away from the moving average for the ratio of gold versus SPX. Right now, we've been in the bear market for 10 years, 8 years. We're at the opposite. So people forget, but one day, as soon as this breaks out here, then full throttle, silver miners, have fun, pick. We're all going to look like geniuses. All these CEOs you interview there, all their stocks are going to go crazy. They won't even know why. It's like, it's just going to go nuts.
Why do you put uranium in there? Because uranium's not money, but was that just as you think that uranium's a good place to be, or why the choice of uranium in there, not say platinum or palladium?
I could have put palladium in there, put platinum in there, put oil. This is real stuff. This is stuff. This is why I said at the beginning, purchasing power, the US oil or silver for a 100-year chart tracks inversely purchasing power, because you can't change those things. So if the more they print those fiats, let's say that supply and demand stays constant, for that supply demand dynamic stays constant for those instruments will reflect the loss of that purchasing power for those for those currencies to buy those goods, right? So they all look alike. I overlaid platinum on this chart. It looks exactly like that. I overlaid palladium to that chart. It looks pretty much like those charts, you know, like if you take a step back and you see the momentum goes up, right? It follows the ebbs and flows, right? It's not perfect correlation, right? But so yeah, anything real, anything, you know, people are going to start knowing these names, like commodities you could put in there. The metals track this very well, but not growth, not US growth stocks. No, not tech stocks.
I'm just looking at that gold and silver miners. It has. Do you think that's the bottom? I mean, it's come
Close.
back a bit.
Yeah, this one I did this chart before the rally. It's October 3rd. Oh no, that's recent. So yeah, this one is pretty. You see, they're erratic. Even in the bottom 2000 bottom, they went really low, right? So miners, that's what they do. But as soon the gold time is going to be when gold breaks out versus SPX, the bottom will be in. So it's going to be just upwards from there on, and then you buy the dips in miners once gold breaks out versus SPX, because the capital flows are going to sustain the rallies in those miners. Right now, we don't have it. So even if the miners did good from, let's say, 2020 to 2021, or like, you know, after March Madness, the miners went ballistic, they still, if you look at it here, gold had not broken out versus SPX. So they did not have those tailwinds to have sustained moves. So gold's the ringleader, gold's the truth. It's the one ring to rule them all. It shows the truth of everything. And it will guide the next, it will tell you where to put your assets going forward. Look, just to show from 2018 to 2020, this is gold versus SPX. Just the move, this is a bear market rally. So gold was getting demolished by SPX since 2011. So eventually gold said, okay, that's enough. I have to try to do a rally. So that's a bear market rally for gold versus SPX. That small rally generated an $800 move for gold from 1,200 to 2,000. So imagine here, when we break out of this early breakout line and we start climbing upwards, $800 is going to be peanut change. So
wow.
All the monetary imbalances that they did, all that stuff, that exponential fiat currency debasement, all that stuff, man, don't get shocked if you see gold, you know, going much, much, much higher, you know? So I'm not shocked. People are shocked. It's like people see Bitcoin or something go up 10,000% or 1,000%. They're not even shocked. They don't even blink an eye. And when you tell them gold's going to go up 100%, they're shocked. What? How could that be 100% gold? It's not.
They do.
The mindset's crazy.
Yeah. And it is about mindset. But so speaking of mindset, I've had a lot of people have almost a defeatist attitude when it comes to silver. We've spoken a lot about gold, but does silver have a place in a portfolio right now? A lot of people just turn around and say, oh, I've lost so much money, or, you know, I should say currency. It's not money, it's currency. I've lost so much currency. What's your view on that?
Pop a chart. Silver, as soon as gold breaks out versus SPX, you're good to go. You're good to go. I'll show you this chart here.
What's this showing us?
It's showing that Bitcoin has been, the capital flows leaving Bitcoin have been more than leaving silver, and actually broke down from this rising trend line, super important rising trend line, actually broke down last month. So even silver, poor man's gold, is now outperforming Bitcoin. So that's another clue we got to really look at, that relative performance of silver versus Bitcoin is changing. The landscape is changing. So this, I call that the bad zone. Look, if ever Bitcoin gets back above this wake up line versus silver, fine. That means the capital flows are re-entering Bitcoin more. But when you're below these two axes here, so the early breakdown line and below the wake up line, when you're in this quadrant, you got to be careful, because with all the other charts I showed you, when you're in that zone, you're not in a good zone. And this is my final roadmap for silver. I did this, it's a slight redraw of a chart I did back in July. In July, it was at 14, silver was at 17 or 18. And like you said, oh, it's the end of the world. It's so awful, right?
Yep.
And then I drew this to show people, look, when it was here, I kept hearing about targets of $14 gold, silver. And I'm pretty sure back here in the abyss of 2008, when it was $10, people were saying, oh, $5 silver, it's useless. You know, I've lost so much money. But exactly when I started hearing that from a lot of people, and then I said, okay, let me look at the charts. And then I put in the 8-year moving average. And then I saw that the price action was reacting nicely to that 8-year moving average. Here's a huge base. So I said, look, this is a lot of support right here. There's a beautiful moving average. It's there. So this was like a few months ago, was I think before we touched it. And now we dipped a little bit lower than I thought, but it's actually bouncing on that 8-year moving average. And here I put a roadmap, I put a wake up line like I did on Bitcoin chart, but now silver, before we get bullish on silver, this wake up line has to be broken above. So until there, I wouldn't touch it, because if, let's say, there's a liquidity crunch or even more selling in the US equities, we don't know how much longer they're going to keep dragging gold and silver until like they're able to decouple. So it's still precarious, it's still a danger zone. But the fact that it's bouncing on this 8-year moving average is good. It's meaningful, you know. That's the beauty of TA, is when you see price reacting to something and somebody who doesn't know about TA can't draw trend lines or doesn't know that, why is it stopping there? Well, my job is to fill in the blanks, put in those trend lines, putting those moving averages, and show them, look, it's just the market forces reacting to a certain area, and that's what we call resistance or support. And this line here, that's my wake up line. So if silver closes above this, I know 28, 29 is the ultimate breakout line for silver. But if ever close above this wake up line, or like here, some crazy like area right here where there's high chances that gold will be breaking out versus SPX on that other chart. There's good chances that DXY will maybe start breaking down, and then we'll go nuts. Well, then you could buy your silver options, your SLV miners, all that stuff that is going to go bonkers. So we're not quite there yet.
We're almost out of time. What I want to ask you is this. What would you say to people right now that they should be doing? Staying in cash, buying gold, getting into Bitcoin, sitting on the sidelines? What's going on? What do you think they should be doing?
Cash. I'd stay for cash for now until we're so close to the confirmation that it's time to go. So you have a choice. Either you go for your emotions. Oh, I'm going to start buying everything now. And then after that, you get trapped, and then there's a market sell-off, and then you sell at the wrong time. Then you have no more cash to ride this reel, because now we're on the cusp of a 10-year bull run for gold and silver. So I don't think a month or two should be in your psychological profile. You should, let the people gamble. But if you have the itch, I don't know, wager a small percentage of get your feet wet with a small percentage of your net asset value, just to get rid of that itch, So
But what you're saying is that a bull run for precious metals is coming. So if they averaged in, they could start to be looking at it now, but just don't go all in. Is that what you're saying?
Yeah, exactly. Yeah. It's hard. Like, yeah, you could start preparing, definitely start preparing. And but the real all-in single, where it's really you want money to buy those dips and everything on the way along, we're maybe 1 or 3 months away from that. We're not quite there yet.
All right. So Patrick, what you need to do is you need to get to me and say, Kerry, we're there. Get me back
yes.
on.
Yes. I'll DM you and we'll.
All right. As soon as that happens, I want you back on. So Patrick Karim, the technical analyst for North Star Bad Charts. If you want to subscribe, they are on YouTube. They have a YouTube channel. But if you want to have a look at what they're doing, subscribe to their work, go to northstarbadcharts.com. God, I love that name. Patrick Karim, the co-founder of North Star Bad Charts. Thanks so much for joining me on Small Caps today.
Thank you, Carrie. It was an honor.